Hello, everybody. My name is Bert Belanger, and I'm sure glad you're with us today. We're going to talk about lower rates for lower carbon. I'm going to be very respectful of your time. Our format's basically going to be, I'll do about 10 minutes of explaining about our company. And then I've got Tricia Baker. She's our Senior Vice President of Strategy and Impact. She's a veteran of long veteran of basically green construction and finance, certainly longer than me. She was with Johnson Controls for a while, and which is based in Milwaukee, and that's relevant because so is Pace Equity. Myself, I'm Bert Belanger, and I'm a recovering dirt lawyer. I went to architecture school, and I've been with Pace now since 2020. It's a new program for Oklahoma, so it's going to be new to a lot of you folks that are on the webinar, and some of you are from out of the state. So I'm going to be in charge of these slides, so you're going to have to bear with me just a sec, but we're going to talk about what is PACE financing. We're going to introduce a new product that only is available through PACE Equity, and then I'm going to leave some time, 5 minutes or more, hopefully, for questions and answers. So I'll trust you'll have some good questions. You can put your questions in the chat, and then of course you can always email me later with your questions. So what in the world is PACE financing? I asked myself this very question 2 years ago when I was contacted, when I looked at PACE Equity as a potential job for me, in addition to the other things that I do as a commercial real estate broker. I really don't practice law anymore, but it is the acronym Property Assessed Clean Energy. And many times you see CPACE, which refers to Commercial Property Assessed Clean Energy. I'm going to talk just a minute about what it is not in terms of the basics. It is not government funding. A lot of folks think that it is. I've worked with government funding. This, in fact, seems a lot more straightforward to me. I was a low-income housing tax credit developer for a long time. This fits into a capital stack much more straightforward basis. And what it really does is it is, in essence, a private-public partnership structure that really started about 2010, and I like to sort of tell the story that those of us that remember the mortgage meltdown and the capital freezing, at that time the Department of Energy went to industry leaders like Johnson Controls and others and said, what can we do to get more capital, private capital, into the marketplace? So those folks like Johnson Controls and others said, well, we think we can finance our components into deals with private capital more efficiently and on a longer term basis if we have some help from the government to mitigate our payment risk. What they came up with was a program that basically is sort of thought up at the federal level, but each state has its own sort of tailored program, and there are about 30 states that have adopted PACE. We'll see that map here in a minute. And it basically allows for whoever collects the real estate taxes to participate with the developer and us as the capital provider to create long-term non-recourse financing that is a great alternative to mezzanine debt, to preferred equity. Really does help boost return on equity, because our cost of capital, while higher than the debt financing that you're always going to have with your bank, is much lower than what it would cost you to syndicate the deal and give up much of the upside and or pay a much higher interest rate and a cost of mezzanine debt. There are some very significant benefits. We are non-recourse financing. we're fixed rate, and we are long-term, up to 30 years. We'll go into why that's the case. So basically, we're tied to essentially the useful life of the components that we fund. Okay, where can we get PACE equity? Here's a map that continues to change because there are states that are continuing to consider PACE. Oklahoma's PACE statute was actually passed in 2019. Texas has had it for quite some time. Wisconsin, where our company is based, has had it for almost 10 years, as have other states like Ohio. We have market leaders in each of these states or in various states that are responsible for these various jurisdictions. And mine is technically Oklahoma, but I can follow relationships really anywhere around the country. I have deals right now in my pipeline in Texas, Virginia, Ohio, and looking at many others. So we follow relationships. We know that deals are hard, and I was hired not so much because I'm a finance expert, because I know people in Oklahoma City. I know who's doing what in the state and in the region, and I myself have been a developer and know how to get things done and get you to the closing table. So that's really the role of our market leaders in each of these places. They're local boots on the ground. Why should you care? Well, CPACE's market is growing very, very fast. We were green before green was cool. You're seeing, of course, a lot of legislation that puts further wind at the back of our industry, that encourages energy efficient construction. But you can see that, and maybe this has to do with me joining the company, but we're rocketing up in terms of growth. And in the coming year, we expect to double the production that we had the previous year. So for once, maybe my timing seems to be really good. There are some on this call that are bankers, and I think that this chart right here lets you take notice that this is gaining in popularity, and so it's important that bankers understand this to be able to best serve their customers. We are not your competition, and we'll get into that a little bit more in the next part of the presentation. Here's I think a great illustration that shows you how we can help optimize your capital stack. Here on the right, you see a conventional debt and equity stack. Banks are being pressured to really keep loan to cost values low. And as we've said, equity and or mezzanine debt can be very, very expensive. We essentially take the place of some of the equity, preferred equity or syndicated equity, and our mezz debt, allow you to keep more of the deal to yourself and not over leverage or overstress the deal. The most important thing in my mind is that you're not giving up the farm in order to get your deal done. The next slide deals with basically what do we fund and what do we pay for. As you might imagine from the name, we fund the things that use water or energy. Those, of course, are the HVAC, all your MEP type things, LED lights. We do have a very robust solar only program where we do solar retrofits. We can get into that more in the Q&A if you'd like. But in Oklahoma and in many states, we also cover components that deal with the building envelope and particularly make the building stronger or more resilient. Many cases in Oklahoma, we now have seismic risks from, as we know, from minor earthquakes we've had around here, but we also deal with wind resiliency from wind damage, flood damage, and just really work to make the building more fortified and stronger. So what typical process is I look at your project, you give me your schedule of values and construction breakdown, and we help you build a PACE loan size. What kinds of deals do we do? We really fund all of the food groups, as you might imagine. Senior housing, hospitality works really well with PACE because it's one of those where energy savings and cost savings flow straight to the bottom line as NOI. As developers, you know that in multi-tenant deals, many times there's really a disconnect between the landlord and their desire, or really the impetus to create an energy efficient building. We start to help to really break that disconnect and align the interests of landlords and tenants. But we can do multifamily, industrial, office. We also do, as I mentioned, solar only, and we can even fund nonprofit projects. We can't fund government buildings, but for instance, a private school that was going to do a renovation with perhaps solar retrofit, certainly something that we can do. What we're looking at, what we're focused on is it a commercial project that generates an income stream that can support not only paying the first mortgage debt, but also pay the PACE assessment, which is additional debt that sits behind your bank debt. How do we do this? I'm glad you asked. There are 87 steps, and don't worry, we do all 87. I know this because I've closed now several deals, and I'm amazed at the work that we put in, mostly in Milwaukee. We have in-house design folks that can help with on the engineering side, and we are a private company that raises private equity. We hold our own paper. We don't just rent money. We have in-house expertise, and we really have a culture that's based in part because of Tricia's and Bo Engman's, our founders' roots with Johnson Controls and in the energy efficiency business as far as equipment is concerned. So again, we do all of these steps, which include asking the local government to opt in. I mentioned that it gets adopted at the state level, then each county or in some states, cities have to opt into the program. We deal with your senior lender. We walk them through the process and explain how we're making the deal stronger. And we help model the deal and size it. And ultimately, we certify to the county that the costs that we're putting into the deal, the money that we're putting into the deal, is covering costs that are actually eligible for CPACE. Since we do this in every single case, even I will say, stop for just a second and say, Oklahoma has a uniquely generous statute in that we don't have to actually show a significant savings below code, but most states do, and we're very serious about encouraging true energy efficiency, not just greenwashing. So we developed a product called Cirrus, and I'm going to let Tricia talk about what that is. It really is I think something that you need to consider as you move forward and look at doing a PACE deal.
Great, thanks, Bert. Hey, just a reminder, if you have a question, you can type it into the chat. That would help us to make sure we reach everybody's questions. So yeah, I'm excited to talk about what we consider the next generation of PACE. It's available exclusively from PACE Equity. It's something that, as Bert mentioned, we put together in partnership with our friends at the New Buildings Institute. So Bert, if you could advance the slide with 2 clicks, that would be great.
I will do that. We need to make sure we've got the chat enabled. It sounds like maybe we don't. I'm getting some offline.
Okay, gotcha. Yeah. So
sorry about that. I knew you guys had really good questions, so we'll work on that.
Yeah, or go ahead, Chris, if you have a question. I turned your voice on if you want to ask it.
Yeah, I mean, we started working with Bert about 1.5 years ago on a deal up in Oklahoma. And I'm still, I still don't understand how you guys make money. So, I mean, I would love to hear that story.
Well, I'll address it very quickly. Yeah, thanks, Chris. I appreciate the question. Well, we are selling, we are providing debt capital. Obviously, our rates are going to be, our rates actually are tied to the 10-year treasury, and we buy money in large tranches, and then we turn around and sell it, obviously at a bit of a markup, and we charge fees in connection with helping you maximize the benefits of PACE, including energy efficiency. So that's sort of the short answer, but we're like every capital provider in a deal. We're going to loan the money and create a bit of a spread. Essentially, because we're a long-term lender, we're in the deal. We can never accelerate our debt or foreclose on it. So happy to answer some more questions like that. What I'm going to ask Tricia to do, because I'm proud of this product, is to kind of run through how we offer essentially a discounted rate program as part of our pricing.
Yeah, so Cirrus Low Carbon is a brand that we developed here at Pace Equity to position this new and innovative product. And the short way of describing it is saying it's a lower rate for lower carbon, meaning that we have developed a specification that we share with you. If you meet the specification, you earn that lower rate. In order to provide that lower rate, and kind of an answer to your question, Chris, we did identify a partner that is sustainably oriented. So because of that capital source, we're able to pass those savings on in exchange for meeting this deeper efficiency goal. So the design specification is for low carbon, which is directly connected with your classic energy efficiency measures. We rallied around the concept of low carbon rather than broader health or the behaviors of the people in the building, for example, knowing that in order to move the dime on things related to efficiency and climate, we needed to address efficiency and carbon. So this design specification was built in tandem with the New Buildings Institute, a very seasoned and accredited nonprofit that is dedicated to advancing decarbonization and building better buildings and improving the building stock throughout the country. So we worked with them to develop that specification. You meet the spec, you get the rate, and then we have a really nice and robust marketing package that is provided, again, once we close. So it's a marketing plaque and a lot of other, ancillary pieces that would supplement you and allow you to promote this, great achievement of having a green building. So it's really three big things: or financial benefits, which you can see listed there. It's a great rate. It's what we know is that green buildings increase your property value, increase your energy savings. When you have a better energy savings, you have a better net operating income. When you have a better net operating income, you have a better property value. But we also know that people want to live and work in green buildings. So we are seeing increased occupancy rates, higher rental rates, and also heightened eligibility for utility rebates and tax incentives, including some of the new tax incentives that have recently been outlined, particularly in multifam, and that are part of the new Inflation Reduction Act that I know isn't officially passed, but it's on the brink of that. We also built, kind of back to what Bert was talking about with our fast track funding process, meaning that we bring all of the activities in-house, so the customer experience is very simple and fluid. We built an internal team that's dedicated to this low carbon effort. So we analyze your current design, no matter where you are in the design cycle, to determine whether you've met the specification. If you haven't, there are things you've missed. We actually have an in-house estimator who gives you an estimate of what that cost would be to meet the spec. And then we develop a business case that outlines exactly the benefit of the interest rate reduction, the cost, if any, of meeting the spec, and then the other benefits that make up your whole kind of data that allow you to make a good decision about whether to move forward with standard PACE or with Cirrus PACE. So at any point, you're able to select which path you want to go down. Once you've got all the data, you can make that decision. And then, of course, that third thing are the brand advantages. So a marketing kit, great and beautiful plaques, case studies, videos, other resources for you. And
Tricia, I've got a question.
Yeah. Oh,
yeah,
sure.
I've got a question from Saxby. I'm getting some of these direct to my phone since we're still having maybe some problems with the chat. But so my friend Saxby says, timeline to get funded on PACE from start to finish. Good question. My job is to work with you on your particular project with your numbers and your scope of once you have your project pro forma'd and designed and concept and your site under control, etc. I can take your pro forma and you've closed on your land, like I know Saxby has. We're basically looking at from the time we commit to you on terms to getting to the closing table somewhere in the range of 60 to 90 days. We can accelerate that some. Early on in the process, you will have the option to look at both our standard pricing and the Cirrus pricing. And what we do in connection with the Cirrus is we take a slightly higher refundable deposit and we mobilize our Cirrus team and we interface with your design folks. They will basically build a business case. This is kind of where this is going, I think. Tricia, so I'll have you chime in here in a second. But Tricia and her group come in and they look at basically all of these things that relate to the building envelope and certain efficiencies, and then essentially give you a cost benefit analysis that helps you decide if you want to change your design and or refine your design to meet the lower carbon test or move forward. And the savings can be basically in the range of 75 basis points to as high as a point. So it's a significant savings that you're looking at. And of course, that figures in the cost benefit analysis. I'm getting another question. What about the impact on PACE if the developer sells? Good question. Our loan is absolutely assumable without fee and without qualification. Our money, remember, is long-term debt. It stays with the property. It's our term and AM is a function of the components that we fund. Lighting being 20 years, HVAC 25. Some of the resiliency components like steel are 100 years. So we get to a weighted average and you've got a long-term loan in place that's assumable. It's non-recourse to you after completion. And so if you're going to sell the property, you obviously are going to consider, okay, what are my prepayment? Do I need to prepay or want to prepay, or should I sell it, market it with this debt in place? We do have a prepayment schedule that is nothing like yield maintenance or defeasance, basically kind of a 3-2-1 prepayment penalty schedule that will impact obviously the business decision that you make in year 3 or 4 or 5 or 10 when you want to sell the property. So I'm gonna let you talk about this slide on this particular case study, if you would, Tricia.
Yeah, of course. So, and I just enabled the chat, by the way, if anyone else has a question and wants to chat it in there.
Sorry about that.
Sorry about that. So this is an example of a hotel in San Jose and what the analysis looked like when we We did the research on the specification. We determined that there were 5 design changes that were required. It was a $40 million development budget, and Pace Equity was funding $7 million of that. And in our and we kind of zipped by some of those, but essentially you'll get a red, yellow, green scorecard as to whether you're meeting the specification measures. And in this case, there were 5 that needed to be analyzed. So the 5 we figured out cost about $67,000. That was what our estimator came up with to give, a nice round number for what we felt was a, great solution for those 5 items. So going down from there, the financial benefits included a 50 basis point reduction, which over 10 years was $320,262. We looked at the energy savings of those 5 changes, which amounted to $71,332. And what we knew from those energy savings impacting net operating income and net operating income influencing property value, we held cap rate flat. We knew that that would total $86,448. So those positive financial benefits totaled $477,770.
So in this case, they did in fact make these changes, right, Tricia?
You know what? This project has not gone to close yet, so it's still in process.
All right.
But yeah, so in this case, so this was the business case that we presented, but we took off those incremental construction costs of $67,000. You can see that net financial impact was still quite favorable. We've analyzed now and put about 10 or so projects through this process that I just described. And one of them, or I should say the one that was already at a great building design and really didn't need to make any changes, still came up, of course, favorable from the interest rate reduction. So there, we've seen across the board and quite consistently that Cirrus has a lot of advantages. So financial advantages, yes. When you think about this green building designation and compare it to one that we know most of the industry knows quite well, which is LEED, just 3 quick things. First of all, we pair beautifully with LEED because of course they're pursuing many of the same things in their design requirements as we are in Cirrus, but we provide that rate reduction. We verify at design rather than at CO, meaning that very early on, you can start marketing your property as green. And then we have no additional cost for application, participation, or for the verification process. And that's quite different than the other green programs that are available.
Well, I'm very excited myself. As an architecture school dropout, I know what specifications are. I've been very excited about teaming with New Building Institute because it creates a standard that is not LEED certification, but it is very much quantifiable, and it allows us to offer this discounted rate program. I'm hopeful that a lot of my customers will consider it. I had another question from Matthew asking about full recourse or limited recourse. We are full recourse during construction, and because we do require, we're not interested in taking construction risk. But once you complete construction and move to CO, then it flips to non-recourse, fully non-recourse. I think this is one I'm going to sort of maybe end with, because I know we're approaching the end of our time. And again, I certainly want folks to reach out to me with specific questions and let me see your deal. But we're very excited. CPACE Alliance is an industry association, and we recently really for a particular project won an environmental impact award. I'll let you speak to that, Tricia.
Yeah, 32,000 metric tons of carbon were reduced in an industrial project that we funded pretty significantly. This was up in Minneapolis. So it's just something we're quite proud of and dovetails really nicely with the goals that we have for the Cirrus promotional program as well.
Whoops, I'm sorry. So again, we've got tons of information on our website. We have some good testimonials that we're proud of. I am very excited to be wearing this jersey for Pace Equity in Oklahoma, and I really want to help you with your deals wherever they might be. So with that, I think our 30 minutes are up, and I sure thank you for your time and attention. Thank you, Tricia.
Thank you. You guys have a good day.
Have a great day.